All right, if you're a Lyft driver, you're going to want to listen to this. There is a very, very good chance you're overpaying on your taxes. We're not talking about a few bucks here and there, we're talking about thousands. So in the next few minutes, we're going to show you exactly where that money is hiding and, more importantly, how you can get it back in your pocket.
Take a hard look at this number, $2,847. What is that? It's not some surprise bonus from Lyft. Nope, it's the average amount of your hard-earned money that drivers just like you are unnecessarily handing over to the IRS every single year, all because of missed tax deductions.
And look, this isn't happening because the tax code is some impossible riddle. It's way simpler than that. It's just a knowledge gap. You can't deduct expenses you don't even know are deductible. And let's be honest, the IRS is never going to send you a friendly reminder about the cash you overpaid. That's on you. Think about what $2,800 really means. For a lot of us, that's a car payment and a phone bill paid for months. It's real money that just vanishes into thin air every tax season, all because nobody ever handed you the right checklist. Well, today we are handing you that list. So how does this even happen? Why are so many drivers leaving so much money on the table? It really boils down to 3 core reasons. Let's break them down. First, you're just not tracking everything. You probably remember to track gas, but what about all the other little things? They add up. Second, so many drivers misunderstand the 1099 form. That number Lyft sends you, that's your gross income before a single expense. It's not what you're taxed on. And third, you might be using generic tax software that's not designed for you. It doesn't know to ask about Rideshare-specific write-offs. You see, this all comes back to one crucial detail. The IRS doesn't see you as an employee. They classify you as a self-employed independent contractor. Now, that's not just a fancy title. It's the legal key that unlocks your ability to deduct all your business expenses on a form called Schedule C. And Schedule C is how you lower the amount of income you actually have to pay taxes on. Okay, so that's the problem. Enough about that. Let's talk about the solution. To really see how powerful these deductions are, let's look at a real-world example. I want you to meet a driver named Marcus. So this is Marcus. He's a full-time driver down in Atlanta, and last year he grossed $42,000. Pretty solid. But by using the full deduction checklist, the one we're about to give you, he found over $11,000 in legitimate business expenses. And just like that, his taxable income plummeted. I mean, just look at this chart. The difference is staggering. His income, for tax purposes, dropped from that $42,000 mark all the way down to just over $30,000. That right there is the power of tracking your expenses the right way. So what did that huge drop in taxable income actually mean for his bank account? Well, Marcus saved about $2,850 in taxes. Now, does that number ring a bell? It should. It's almost the exact same average we started this whole explainer with. This isn't theoretical. This is what's possible. And here's the part that really hits home for me. Marcus wasn't some tax cheat. He was filing his taxes every single year. He really thought he was doing everything by the book. That $2,850 was just gone, overpaid and lost forever, simply because he didn't know what he didn't know. Okay, you've seen the problem, you've seen the proof. Now, let's get down to business. Here it is, the complete deduction checklist. This is what you can and absolutely should be deducting. Your first and biggest decision is how to deal with your car expenses. You've got 2 choices here. The standard mileage method is super simple. For 2025, you get to deduct a flat 70 cents for every single business mile you drive. Or you can use the actual expense method, where you track every penny: gas, oil changes, insurance, all of it. Honestly, for most drivers, the mileage method is easier and saves more money. But here's the golden rule. You have to pick one method and stick with it for the entire year. No flip-flopping. Mileage is the king of all deductions. It's huge. A driver doing about 1,200 business miles a month can easily hit a $10,000 deduction. But don't stop there. You can deduct the business portion of your phone bill, usually 80 to 90%. All those little accessories, like your phone mount or dash cam, deductible. Keeping your car clean with car washes, deductible. And here's one most people forget. You get to deduct half of your self-employment tax, automatically. And hey, here's a little pro tip for you. You can actually stack rewards on top of these deductions. I mean, you're buying gas anyway, right? So use a credit card that gives you cash back on that purchase. A card like the Citi Custom Cash could put an extra $300 back in your pocket. It's about getting paid twice for the same business expense. All right, quick gut check for you. Right now, which method are you using? Mileage or actual expenses? Just taking a second to answer that question is the first step to making sure you're getting the biggest possible refund.
Claiming all these deductions is an absolute game changer, but you have to do it by the book. So this next part is crucial. Let's talk about how to get every dollar you're entitled to without raising any red flags with the IRS.
Just follow these 3 golden rules. 1. Log your miles. You have to have a record. An app makes this ridiculously easy. 2. Choose one method. We talked about this, but it's so important. Pick mileage or actual expense and stay with it for the year. And 3. Be defensible. Be honest with your percentages. If the IRS were to ask you to explain why 85% of your phone bill is a business expense, could you do it? Your records need to tell that story.
And here's exactly why this is so important. If you get audited and you can't prove your mileage with a log, the IRS has the right to completely disallow your entire claim. That $10,000 deduction we just talked about, poof, gone. And on top of that, you'll get hit with penalties. Your documentation, your logbook, that's your shield.
Okay, let's make this super actionable. Here are 5 things you can do the minute this is over. 1. Go to your app store and download a mileage tracking app. Do it today. 2. Figure out your phone's business use percentage. 3. Create a folder, digital or physical, I don't care, and start saving your receipts. 4. If someone else does your taxes, confirm with them that they're using Schedule C for you. And 5. Always run the numbers for both mileage and actual expenses before you file to see which one saves you more. Let's just quickly recap the numbers that really matter. $2,847. That's the average amount drivers are missing out on. 70 cents, that's the powerful per mile rate for 2025. $10,080, that's a totally realistic annual mileage deduction. And $2,850, that's what a real driver Marcus put back in his wallet. Which really brings us back to the most important question of all. What are you going to do with the extra $2,000 or $3,000 you save this year? Think about it. And make sure you join us for our next explainer, where we're going to tackle how to handle those dreaded quarterly taxes and avoid underpayment penalties from the IRS. And one final very important note. This information is for educational purposes only. I'm not a tax professional, and your situation is unique. So please always consult with a qualified accountant or a tax advisor to get advice that's tailored specifically for you. Thanks for watching.